Alix, Paul Sweeney. We are live at the offices of BAM Mutual, Build American Mutual. They're down here in Lower Manhattan. I call it the World Financial Center. I think they now call it Brookfield Place. That's what the kids are calling it. I don't know. We are with the leader of Build American Mutual, BAM Mutual, Seán McCarthy, BAM Mutual CEO. Seán, we've been here coming many, many years. Last year, I think in 2024, there was $500 billion of new issuance in municipal bond market, a record. A, what drove that? And B, what are your expectations for 25?
So first, thanks for being here. It's a really great tradition, and and we really enjoy being the host. So last year was a record year at $507 billion, and I think the big driver there, interestingly, was new issuance for infrastructure projects. Okay. So 75%, $335 billion worth of paper that came was for new schools, bridges, tunnels, roads, hospitals. So really essential public purpose infrastructure. And I think that's going to continue. If we look at, as an early indicator, the number of referendums that were approved. In California alone, there were $50 billion worth of school bonds that were approved. Nationwide, there were $100 billion worth of new projects that were approved. So we can see that there's going to be a huge demand for projects that have been deferred in some cases over 10 years. So.
Oh, what about demand? Just in terms of the older the population gets, the more that tax-free incentive might be more interesting to people. Like, what are you guys noticing on demand? So, for us, we focus. At BAM. We only guarantee municipal bonds, and so I think the real demand, as you've put it, both for separately managed accounts or for direct retail or the big funds, there is a value proposition that was described earlier. In essence, people want more to take home, and so the tax exemption on the bonds serves two real core purposes. First, it lowers the cost to build these essential infrastructure projects. That's critical. The second thing is it provides a tax advantage so that actually investors can feel like they're part of building America.
What percentage of new issuance gets your insurance from Build American Mutual? And is it a need thing? I need your insurance to make it a lower rate? Or?
So no. So basically, what bond insurance does is we're a AA rated company from Standard & Poor's, and so essentially we put our guarantee on a municipality's debt to lower the cost of borrowing. So think about it as you co-signing your kid's student loan. So if you think about it in those terms, you want them to get a job and you want them to pay back their student loan, but if they don't, you're paying. So we acted in that role. We are guaranteeing timely payment of principal and interest when due on the bonds. And so that does two things. It makes investors comfortable that they have liquidity, a higher rating, and it lowers the cost of borrowing for all of these.
And is that widely used by issuers?
So if we think about the overall market for utilization, I'd say it's around 10% of the overall market. But the important thing to think about is that bonds that are rated AA or better don't use bond insurance because they have a strong rating on their own. And there's a certain class of bonds that are, lower rated than would be acceptable for the industry. And then there's certain sectors that aren't guaranteed.
So we've been coming here for, 7-9 years, right?
Yeah,
Something like that. What's the biggest change that you've noticed, like in the last decade, in terms of what we cover, what you cover, in the zeitgeist of the muni market? So
I think the muni market's changed quite a bit in the last decade, and it's had a lot of events that it's really addressed handily. So if you think about, for example, COVID, I mean, it feels like COVID was ancient history, but think about that. People stayed at home, so bridges, tunnels, airports, toll roads, just what their utilization was dropped precipitously. And so the market withstood that. There were really, in essence, very few defaults on those transactions. And so what you see happening in the market overall is this, I think, pent-up demand for new projects. I think a lot of people, because of COVID and because of federal monies that were given to them that have now sort of burned off, you can see this pent-up demand to come with your new project at this point and come into the market.
One of the themes that I think we just observed today is kind of the natural disasters and how will that impact the municipal bond market? From your perspective, how do you think that's going to play out? Because it seems to be a thing.
It's a real issue.
Yep.
So think about what BAM does. We spend 99% of our time looking at things that happen not very frequently. One of the things we focus on are natural disasters. So if you think about hurricanes, floods, earthquake risk, and right now wildfires, these are all things that we incorporate into our underwriting process. We evaluate them, and it affects what we guarantee based upon what we think that particular risk is. So we turn deals down if we find that they're in an area that's more prone to exposure to these particular kinds of natural disasters. And we use a lot of analytical tools that are available and some that we've developed ourselves to measure what that severity is. So if you look at Los Angeles, for example, I mean, if you're looking at credits that are county-wide or city-wide in Los Angeles, it's a really big area. The county's 100 square miles. And so even though there's been a couple of terrible fires there, the overall, stability of the county and the city are still quite strong, and they'll have the ability to sort of address this and overcome it.
I can see, though, that being a very quickly evolving, changing topic that must be very difficult to assess.
I think that is true. But remember, the way we look at credit risks, we are guaranteeing the bonds till the last payment is made. So if you have 30-year bonds, the way we look at credit risk is not this sort of shorter cycle.
Sure.
We're looking for, and one of the great strengths of municipal finance is that the issuers and ourselves and the market in itself are aligned, so that the city of Pittsburgh or the city of New York or school districts and local school districts all want to pay, fund their transactions with municipal bonds because it lowers their costs, but they want to pay them back. So, and that's an important thing that, in other kinds of corporate credits, sometimes those interests get misaligned.
Interesting. All right, Seán, thank you so much for taking some time here. Seán McCarthy, he's the CEO, boss around here. We appreciate him having us every year. He's Seán McCarthy, CEO, BAM Mutual. We love coming down here talking about the municipal bond market. There's so many assets and facets to that market, so we always appreciate coming down here.